Well, again, you keep coming back for more. So let's take a look at the third lecture or third module of our module 5 analysis. So we're going to be looking at receivables, discounts, write-offs. And if we take a closer look, I want to get some big picture stuff first. So we start with sales allowances. If we look at the revenue side, we talk about net sales, and I'm going to make a point. Net sales is our 100% number that shows up on the income statement. What do you mean? I thought, isn't it just says revenues, right? That's what most of the income statements you've been seeing so far, and that is correct. But that is net sales because you have gross sales, sales revenue. You take out returns. I don't want it. It's broken, whatever reason, and allowances, which are a form of discounts. All right, I'm going to give you 10% if you buy so much more, if you buy volume, whatever it is. By the way, sales discount is not discounting like we go to the store and get 20% off sale. Sales discounts specifically refer to cash discounts or terms discounts. So you might have heard of 210 net 30. I get a 2% discount. If I pay within 10 days, I get no discount if I pay within 30 days. And that discount is money you're never going to see. So if you had a $100 invoice and you got paid it in 10 days and you save $2 and $98, you look at that and say, am I ever going to see that $2 again? No, I just gave a cash discount to the customer because they paid earlier than the net terms associated with that sale. So we have availability and examination of saying we get cash discounts that we're never going to see. We have returns that are not really sales because they came back at us. And we have allowances that are the actual discounts that we're also never going to see. So we need net sales to show up. Another aspect, though, on the balance sheet is about receivables. We have something called the allowance for doubtful accounts, ADA. Not that ADA, the law, Americans with Disabilities Act, but allowance for doubtful accounts says, I don't expect to receive 100% of the billings to be paid. So I might expect 98%, 96%. I have a portion that I need to recognize fairly quickly of what I sell that's not going to get paid. Now, frankly, if you knew you weren't going to get paid from a customer, you wouldn't give them credit, would you? But you don't know. Companies go bankrupt all the time. Individuals move around all the time. And bills sometimes do not get paid. So we need to have this net accounts receivable, which again is what you usually see on a balance sheet. But the awareness, and there are companies that have played games. If you ever heard of Health South out of Alabama, they started the rocky road of lies and deceit and fraud by just adjusting their allowance for doubtful account. We don't think we're going to get 3% of our accounts. But if we now know we think we're not going to get 2%, we get that extra 1% we can show as revenue. And maybe we can make that 2% 1.5%. And that's the slippery slope they went down and ended up major fraud, major challenges. So let's take a closer look at what we're talking about when we talk about allowances. So customers have a right of return. So is a sale really a sale? We were talking about that in revenue recognition. Sales discounts for volume purchases. So that's where the sales, let's go back up here. We look at the returns and allowances. That allowance is the discount. Again, not the sales discounts associated with cash discounts, but the allowances that go with that. And then retail promotions, point of sale price markdowns, and other promotions. So this actually reduces the amount of the sale. The company's receiving less cash. So if we're going to receive less monies, it can't be, it's a $100 list price and we sell it for $70. We can't record a $100 sale because we're never going to see the 100. We know it's $70 is what we're getting. Under GAAP, companies must report amount of cash expected to be received, the net sales. That kicks into our allowance discussion of, allowance for doubtful accounts. I expect to receive 100% of what I sell. And if it's a cash sale at the door, probably is, unless there's a bounce check. But typically, if you have receivables, 10, 20, 30, 60, 90, 180-day receivables, you may not get paid. Or you may have to work out special payment arrangements or give further accommodations for whatever reason. The customer says, I don't like what I got. It smelled funny. It looked funny. It tasted funny. It didn't work the way it was supposed to work. Now you have a discussion saying, I don't know, maybe can we negotiate this? Companies must deduct from gross sales the expected sales returns and other allowances. So that's what we have in that other picture, the big picture we were talking about. So let's take a look. Assume the following: Levi Strauss, jeans to a customer for 130. And be careful, by the way, when we talk about sales, we're talking about wholesale versus retail. Levi's normally doesn't sell direct. They're going to sell into distribution or sell to a retailer, and the retailer sells to you. So be careful about making assumptions about profits and how much money goes to whatever the supplier was. But let's just take a look here. We have an estimation of an allowance to the returns and allowance account here for a $130 pair of jeans. They cost us $80, and returns are expected to be 3% of sales. So we make adjustments for that. We go ahead and allow, because we want at the day of sale to recognize not only if something's going to be returned and what percentage. We do the same thing for warranty stuff. If you buy a car, not all transmissions are going to be bad in the first 12 months or 100,000 miles, depending on what kind of car you get and what the warranty is, but some will. So you have to allocate a part of that selling price to warranty expense and to anticipated warranty work. You have to allocate some of that uncollectible, and you have to allocate some of that to returns. So here we go. Sales net is the 130 minus 390. So net sales is what's showing up in revenues. Cost of goods sold, we actually adjust the cost of goods sold to go with that as well as a percentage. And that revises our gross profit. So it's not as easy. I got the $100 TV at Best Buy. It cost them $800, $200 gross profit. But some of those are going to come back. Some of those, and there's going to be some warranty stuff that maybe Best Buy has to pick up or the manufacturer. Sales allowances. Companies provide a reconciliation, sales returns, discounts, and incentives. Okay, so we look down here, balance, and we have adjustments going to that. So we have additions and deductions associated with the sales allowances. We go a little bit further. There are three elements and ratios that we will be talking about and want to have a comfort level with. We're not going to really be heavily tested on this. Don't close your ears right now, but be aware this helps visualize the concepts that we need to worry about. So we've got 3 points here, and I'm going to go to the next slide, which actually isolates those 3 points. One has additions charged during the year over gross sales. And then we have allowances over gross sales. And then we have something called adequacy, which incorporates a balance sheet as opposed to the income statement. And we're looking down at these and saying, if we have sales returns, sales discounts, whatever else associated during the year, we look down here and we say $600,000 out of $5.5 million is never going to be seen. So our gross sales was 6.179. Our net sales are 5.575. We have almost 10% of this stuff is not a sale of the 6.18 million. So we got to go ahead and adjust for that and look at our net sales. We look down here, we have the allowance account. We have total allowances that went with that, and we take that allowances as a percentage of sales. So in this case, it was 3.3%. And then we go ahead and we talk something about adequacy. We'll go back to that in a second. Let me go and explain the terms, a little more details. So the three metrics: additions charged to gross sales. Measure the income statement amount. We reveal those effective pricing pressures on net sales. So it really will tell us that, well, if we're given a bunch of discounts, there might be pricing pressures. And expect this percentage of sales allowances to gross sales to increase as pricing pressure increases. We're given more discounts. That makes sense. To give more discounts, that must mean there must be pricing pressure. We also have allowance as percentage of gross sales. Measure the balance sheet amount. Okay, so we're looking at the allowance account. And adequacy of the allowance amount. Compose the dollar amount of the estimate for future sales returns to the amount actually realized. So we're projecting and we're comparing to what we actually have and actually have done. So this is a picture. Somehow that got moved over. Let's go back down where it goes. And we have the ability to take a look at some ratios. I'd emphasize, if I'm taking a look at this slide, that first one and that second one. The first one is telling me, okay, what percentage of a sale is not a sale? And the second one is, what's the allowance percentage? Remember we talked about health south, and we're talking about 3%, maybe 2.5. Well, the bottom line is directly affected. If you get rid of some of these percentages that you put in the allowance account, because you have a bad debt expense that you put on your books, if that bad debt expense goes up, you get smaller profit. The bad debt expense goes down, a smaller percentage of your receivables or sales. When you adjust, you can do, there's two methods to do that. You can go ahead and get a higher profit. And a lot of companies are pressured to show that higher profit. So that concludes our third examination for Module 5. And we're going to go ahead and take a deeper dive and go into our fourth.